Hello and welcome to Payden's 2019 Emerging Market Debt webcast, Navigating the World of Emerging Market Debt. My name is Maurice Salon, National Accounts and RIA Services covering the West. For your convenience, we have listed your Payden team members' contact information at the conclusion of the webcast. I'm pleased to introduce our speakers, Kristin Ceva, Managing Principal, Arthur Hovsepian, Principal, and Alexis Roach, Vice President here at Payden. Before we begin, a few housekeeping items. You have access to the Webex Chat capability where you can ask questions in the lower right of your screen. And we have dedicated time in our Q&A session at the close of the presentation to address these questions. This is part of our webcast series. Keep a lookout for more information on future calls. A final note, this call will be recorded and the presentation will be available on the Payden site. Without further ado, Kristin, take it away.
Thanks, Maurice. Well, before jumping into some of the themes that we're seeing for emerging markets going forward, I just want to set the stage from a global macro perspective. And on the first page of the webcast, you can see a graph which shows negative yielding debt stock reaching a record level in 2019, almost 16 trillion. So emerging market debt within this context is quite interesting to investors because it offers the potential for getting exposure to sovereign debt with a much better yield profile. This global backdrop has also been very supportive of flows into emerging market debt. We've seen that a similar pattern occur in 2016 with the buildup of negative yielding developed market debt in that year, then followed by emerging market inflows into 2017. So we're seeing this pattern again this year in 2019 after the buildup in negative yielding debt as investors look to emerging market debt for a better alternative. And so we've seen about 56 billion in inflows so far this year, mostly in the hard currency space. Last quarter, with the dramatic move in global rates markets, we've also seen quite a bit of focus on fears of Japanification in the market, spreading to Europe and potentially also the U.S. Again, I think emerging markets is a contrast to developed markets with regard to these particular concerns. As this chart shows here, you can see how better demographics, younger populations, which also are highly correlated with the potential for higher growth rates, as well as higher yields. So you have that sort of converging there in the emerging market space as compared to the lower quadrant for the developed markets. A trend we've been seeing with regard to asset allocation is that investors are seeing emerging markets as a strategic asset class and not just playing it tactically anymore. Many investors used to really just invest solely in emerging market equities, and that thinking has changed pretty dramatically. And investors institutionally are now moving towards a more balanced allocation. And if you take a look at sort of the risk-return profile that you're getting in emerging market debt, and emerging market sovereign debt U.S. dollar, second from the left-hand side here marked in red, you can see that annualized return at 8.4% has been pretty similar to what you're getting in EM markets, in equities at 7.6%. And the annualized volatility of 7.9% is almost a third of what you're seeing in volatility in emerging market equity at almost 21%. So again, that sort of risk-adjusted return has led investors to not solely invest just in emerging market equities, but to really have a more balanced perspective and to include emerging market debt within their asset allocation. Another rationale for holding EM debt strategically and not just tactically is because of its long-run income potential. You can see this over time as we've looked here at the MD Global Diversified, which is the primary index for dollar pay emerging market debt that investors track. And a very large part, about 85% of the total return of this EM asset class has come from the income component. So again, that's the rationale for holding the investment over time and not sort of selling in and out tactically because you want to earn that income. And we can also see that the income level for emerging market asset classes are high, particularly when you are considering the credit quality. So you're getting almost the same yield in dollar pay sovereign debt at a BBB minus average quality as you are in U.S. high yield, which is a single B plus average credit quality. So I think it stacks up quite well to other potential alternatives in fixed income. The opportunity set in emerging markets has also broadened very dramatically over the last decade or so. Now we have 73 countries on major EM bond indices, and that correlates in terms of the global GDP represented to 31 trillion. And so on the shaded blue countries, these are all countries that are included in major EM bond indices. So we have a lot of different countries to choose from as we're assembling a portfolio. And we focus not just on the mainstream, larger emerging market countries, but also on smaller countries where we see a lot of opportunities both for growth and total return potential. This is the Next GEM index, which is a subset of countries within the main emerging market bond index. And it represents a very diverse group of smaller issuers. Many of them are first-time issuers. And the green line is tracking the total return versus the main index. And as you can see over time, that next-gen index has outperformed. Again, because many of these countries are coming at a higher yield, and also because many of them are turnaround stories that are on an improving trajectory fundamentally. Going forward, we expect emerging market growth to outpace developed market growth. This is important because it's this emerging market to developed market growth differential which drives capital flows. We track current activity indicators, and that is interpreted as a growth signal because it tracks high-frequency economic indicators. And the differential here between emerging markets and developed markets has started to pick up quite a bit in 2019. And we expect that to continue going forward, particularly as developed markets in Germany, other countries in Europe, the US have been slowing down. That's true also on the manufacturing PMI side of things, where we're seeing lower PMI readings, which are pretty widespread, but definitely more pronounced within the developed market world. And also importantly for growth, emerging market central banks have more room to ease going forward. Inflation is low, it's well contained, and central banks in emerging markets are becoming more accommodative. It was difficult for EM central banks to ease last year when the Fed was in more of a hiking mode, but as the US Fed changed its stance, that really gave more room to emerging market central banks to ease. And we've seen about 40 central banks already ease policy in 2019. We're also, in the last couple of months, just seeing the first signs of credit growth trending up in emerging markets. So we're starting to see an impact of that easing. On the external side, in terms of the balance sheets of emerging market countries, most of them are pretty healthy. You can see this on the left-hand side in terms of the chart of current account deficits, which have been improving, particularly since the taper tantrum. From 2013 to 2015, with the taper tantrum followed by commodity crisis, these countries allowed their currencies to gradually depreciate. Most emerging market countries now have floating FX regimes as opposed to pegs, so it allows for gradual depreciation over time. So I think that's something that really helps those current account deficits to become more healthy and for foreign exchange reserves also to build over time. On the political side of things, in terms of key elections that we've seen so far this year, Ukraine, Indonesia, and India, those elections have all been very market friendly. So Zelensky in Ukraine has been negotiating with the IMF. In Indonesia, Joko Widodo has been reelected and running on more of a reform platform, which we think is very positive. And then Modi reelection in India, I think, has also been quite market friendly. The exception to this, of course, is Argentina, which Alexis is going to talk about a little bit more in due course. So with that, I am going to turn it over to Arthur to talk a little bit more about local markets.
Thanks, Kristin. As Kristin mentioned earlier, the landscape and the number of countries in emerging markets has grown. That applies to local EM also, not to the same degree as hard currency, but nevertheless, you'll see the local landscape, the majority of the countries listed here on this slide. A couple of interesting observations here. Firstly, the wide dispersion you'll see in terms of yields on offer. Clearly, the frontier and some of the smaller countries offering the double-digit yields on the right-hand side of the page, but you really have the full range of yields and those towards the left-hand side more closely linked to core Europe in particular, so the Central Eastern European countries having the lowest yield in the universe. In terms of investing in local, key consideration obviously is the currency outlook. We're of the opinion that the US dollar is in the process of putting in a top following its secular bull run. We've already seen this year the US outperformance versus the rest of the world plateauing. Central bank policy making is also a little bit more balanced with the Fed turning dovish. But fundamentally, I think it's important to highlight the US dollar does seem overvalued. And what we're showing here is on the left-hand side of the page, the budget balance deterioration in the US coming at a time when the output gap has turned positive, and taking that over to the right-hand side of the page and overlaying the US dollar, you can see the valuation of the US dollar does seem stretched. And for us, even if there isn't a meaningful depreciation of the dollar, there is scope for EM to outperform because the pressure on the dollar to appreciate simply isn't there. A hot topic on the minds of fixed income investors globally is the opening up of capital markets in China. The table on the left here shows an estimated flows into the China bond market based on index inclusion into the major indices shown. So the GBI-EM, that's the major local index, the Bloomberg Barclays Agg, and the WGBI, the World Government Bond Index. Combined, based on index weighting, we're estimating around $250 to $300 billion of inflows into the China bond market. Separately, you look at China's bond market being the second largest in the world with only 2% foreign ownership. That's significantly below the peer group in emerging markets, but also developed markets. So there definitely is scope for flows to provide that additional technical tailwind to the opening up of the markets there. But there's also a supportive investment thesis to go with this technical positive. China is in the midst of a structural slowdown with an aging population set to keep inflation and rates low for years to come. The interesting thing about China's bond market is also a unique case where a country officially categorized as EM is probably going to get just as much attention from developed market investors. So the chart on the right-hand side, we're looking at real yields of China, but in particular looking at China real yields versus countries with similar rating, liquidity, and size. Obviously, China's real yields stand out as being very attractive compared to those. With that, I'll turn it over to Alexis.
So I think I'm going to start with the most upbeat story in Latin America, and that is Brazil. This is one of the standout stories in emerging markets because we've seen a shift in macroeconomic settings, which started in 2016, but has really shifted into high gear. So I'm going to start with the chart on the left, and that's the Brazilian inflation. So when I say shift in macroeconomic settings, we saw in 2016 an impeachment, the economy was in pretty dire straits. We saw a new government come in that was intent on anchoring the macroeconomic framework. We saw the appointment of a very strong central bank governor. So what we've seen over the past 2 years and change, or 3 years now, is that the central bank has been able to cut rates, cut aggressively in the context of declining inflation. So this is a first for Brazil. You're going to be in the third year of inflation coming in below target, and you're going to have a historically low interest rate, both in real terms and in nominal terms. And I think part of this exceptional trend and I guess the way that people are looking at this is the fact that there's a reform agenda that's behind this. So it's not just on the inflation and the monetary policy side that we're seeing these tailwinds, but this comes in the context of a broader reform agenda. If we're looking at the central bank, they went to the IMF World Bank meetings, which I was at, speaking about how they're going to try to deepen monetary transmission, how they're going to try to unlock hidden productivity through financial deepening. But this actually extends well beyond that, and that's where we go onto the right side and see a table of the Brazilian reforms. I'm going to focus on the fiscal because that's where we've seen the biggest headline reform in the last week past, and that was the Social Security reform, which the last government tried unsuccessfully to do. This government has done, and from here, we're expecting to see a number of other measures start to fall into place. So the Social Security reform was the anchor, and we're expected to see new oil auctions that are going to move forward, possibly central bank administration, independence, and administrative forms that could also buoy the fiscal accounts going forward. So the story with Brazil, I think, is one that we have been riding a wave of optimism on and feel pretty convicted that this is going to be a good story in the next several months. If we move to the next story, Mexico, I think that this is one where we have a more nuanced view because Andrés Manuel López Obrador came into power, and because he is left-leaning and his rhetoric and headline actions have not always been friendly, he has been labeled a populist. I think it's important what we're seeing with AMLO to qualify what he actually, or what the label is that we actually put on him. I think the fair thing to say is that AMLO is very much an ad hoc populist. So he takes populist-like measures like canceling the Mexico City airport or deciding that foreigners cannot invest in the energy sector when it suits his political needs. But when it comes to fiscal and monetary policy, AMLO has actually been very hands-off. And we're seeing on fiscal stance that even in the context of much slower growth, there's been declining primary spending, which is expected to continue into 2020, which is shown in the 2020 budget. So as one analyst said to me on the political side, AMLO is not one for fiscal adventures. And I think that that very much applies to the central bank, too. He is not one to make monetary policy and has actually appointed governors that have been doing their job. So I think fears on that side have been allayed for the time being. Where we see the most opportunity is really in the corporates, or in the case of Pemex, the quasi-sovereign, where the fiscal or the Treasury and the government have started to show more overt support. So we saw Pemex, which really blew out towards the middle of this year, start to compress as the government has promised a $5 billion equity injection, plus cutting of taxes, the profit-sharing taxes, so that the company can become stronger on a standalone basis. We think at 250 basis points over the sovereign, there's still opportunity there. And in line with Kristin's promise to speak about Argentina, I think that the best way to describe the current situation is what the title says, and this is the politics of uncertainty. So we have a new president in Argentina who won by 8 percentage points more or less on Sunday. and he is from a left-leaning party. I think from what we are expecting is that he comes into power and faces a very difficult situation where there are limited degrees of freedom to maneuver. And I think from here, what we want to emphasize is there is a right way and there's a wrong way to deal with the situation. The right way is to try to generate a positive shock of confidence, and that is in the context in which you've already seen the currency come under extreme pressure and you've had to implement capital controls. The way to do this is pretty clear, and I think that Alberto Fernandez has been talking to a lot of people. So this is not a mystery. This is going to the IMF, negotiating the country's debt, coming up with a plan on the fiscal and monetary side, a package which is sustainable, then negotiating with local creditors, and finally with external creditors. Obviously, this is not an easy process politically, and that's why the bonds are trading as low as they are. But with bonds in the 40s, we do see that a lot of the bad news has been priced in. So from here, we're looking at historical restructuring and seeing somewhere between 50 to 60 cents as a rational kind of target that the government can get to if they are able to follow the steps that we outlined. And with that, I will turn it over to Arthur for some closing remarks.
Thanks, Alexis. So in closing, just want to kind of run through a few of our top picks in the various sectors. Firstly, on hard currency, and in particular on investment grade, Indonesia, Kristin mentioned the reform progress. That's very much still intact and sovereign heading in the right trajectory. The rest of the exposure on the investment grade side is really focused on Latin America. Uruguay and Colombia offer good value. In Mexico, we prefer the 100% government-owned entities there. On the high yield side, we have a little bit more regional diversification. So Africa is a region we like, in particular Ghana, Angola, Ivory Coast. In Asia, top picks are Mongolia and Sri Lanka, Guatemala in LATAM, and Armenia in Europe. On the corporate side of things, investment grade, we're looking at companies that really have a global customer base. So in Mexico, Comita and Fermaca are top picks. Other than that, we really like the valuation, in particular when compared against the sovereign, the spread to sovereign, and some of the state-owned names in India, Colombia, and Russia in particular. On the high yield side, in particular Brazil, the way we've been positioned there and corporates that we like, really Petrobras stands out as a clear winner for us, and the spread to sovereign, although has compressed, we still see a lot of value there. On the local market side, just to wrap it up, core holdings include Brazil, Peru, Russia, Indonesia. All these countries have already been cutting rates quite aggressively, but we feel that there's a lot more to go, and currency fundamentals are also pretty strong, and we like to take those on an unhedged basis. And in frontier markets, several of the countries we're involved in: Ukraine, Nigeria, Kazakhstan, Sri Lanka, Dominican Republic, and finally Egypt. And as I mentioned earlier, not only are the investment theses of these countries good, they've also provided great diversification over the past few years.
Thank you, Arthur. We would now like to take your questions. If you have not already, feel free to send your questions now via the chat capability on the lower right hand of the screen. We have a few questions that came in during the call. First, I've heard a lot about EM countries and companies issuing in US dollars. Doesn't that create a currency mismatch problem if the US dollar continues to strengthen?
I'll take that. I think that with regard to what we sometimes see in the media about growing US dollar issuance in emerging markets and the concerns about that, one of the things that is often cited is just that dollar amount has continued to increase over time. But we don't think that's the complete way of looking at it, because you really have to look at that as a percentage of overall GDP, and that GDP has also increased over time. And we're happy to share some analyses that we've done on this, but the overall external or U.S. dollar pay debt to GDP in these countries has stayed very steady over the last decade. So we don't see concerns there in terms of an increasing debt load in terms of external debt to GDP. On the corporate side, I think that it depends very much on the type of corporate, and we look at that on a sectoral basis. So there are corporates where depreciation in their home currency is beneficial, if they're an exporter, for instance, and others where if they're more geared towards, say, the internal consumer markets where it's more harmful, but they may have hedging policies that can provide some protection against that. So it really kind of comes down to more of a sectoral and case-by-case basis on the corporate side.
Thank you, Kristin. Next, are there any EM countries with negative interest rates?
The answer to this is going to be short. No, is the answer. I mean, if you're going to be full detail, I think the front end of one of the markets in our universe, Hungary, is slightly negative, but 99% or close to 100% are going to be positive yields.
Thank you, Arthur. Our third question, what impact is the trade war having on the dollar in EM countries?
I'll start off answering that one. I think the main kind of impact we're seeing on emerging markets is through the sentiment channels. And the dollar, in turn, has received a fair share of flows through flight to safety. It, however, is temporary in nature because there's so much uncertainty around the outlook. It has to be said that there are countries benefiting from diversion of supply channels. But overall, I think the main effect it's had on EM is really through the sentiment channel and the investment channels kind of preventing the full growth and full growth potential being realized in EM. Kristin mentioned earlier, we have many central banks around the world cutting rates to offset that and act as a buffer. And that really for us is offering a great kind of comfort in many of the countries in terms of offsetting some of that negative sentiment. But for us, I think the fundamentals of emerging markets right now are strong enough for them to withstand this current uncertainty around trade wars.
Thank you, Arthur. It looks like our final question, and with that, we're coming to the close of the half an hour. So we want to thank you for listening to our 2019 Emerging Market Debt Update. We've included the dedicated funds team contact information and our general email address, as well as phone number, where you can reach out to receive our economic commentary and subscribe to our webcast series. As mentioned, the recording will be emailed directly. We thank you for joining us today and look forward to having you at our next webcast in the series. Take care.